This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
This is episode 94. And speaking of episodes, I think you have something to share.
Yeah, we were expecting a new baby, and she arrived at 2:20 a.m. on Friday. So we were hanging out in the hospital until 3:30 a.m. the following day because they made us stay for 24 hours. And as soon as it was 24 hours was over, I was like, all right, let's go do the tests we have to do. And then when all that was done, went home. And they're like, are you sure it's 3 o'clock in the morning? I'm like, no, we're going home.
So that's when you came home?
Yeah. The doctor's like, well, why don't you just sleep and go back in the morning? I'm like, no.
So what is it like in hospitals now?
Well, when you go in, there's an entrance specific, not completely specific, but intended for the maternity ward. You go in, there's a screening. So at the very front, they make you sanitize your hands. I don't know if they were giving out masks or not. I had a mask on when I went in. And then they ask you, do you have a cough? Do you have a sore throat? Have you traveled? Have you been with anyone that's traveled? No, whatever. And then they'll only let you in if you've been called. So Susan had to go in by herself first. I couldn't come in with her. And so she goes up, the nurses assess her, and then once the nurses say like, yep, baby's coming, then I was allowed in. So when I went in, they did the screening, but they also made sure that I'd been called up. And then once I was in the maternity ward, they screen again. So I get there, the nurse asks the same questions, takes my temperature, and then once all that is done, they escort me into a room, and then you're not allowed to leave that room.
At all, until you leave. So you have to bring your own snacks and etc.
I brought snacks, but they were actually pretty good about giving both the patient and the partner, me in this case, meals. Usually they would just give it to the patient, but because of what's going on, they gave meals to both of us.
Wow. So your house is busy and your mom was there. Listeners know your mom.
Yeah, that's right. They do. Yeah, my mom started staying with us at the beginning of the month. So almost 2 weeks she's been here now.
Amazing.
Yeah.
So Susan's feeling good.
Yeah. Everything's good. I mean,
awesome.
Typical just had a baby stuff, but all good all around.
So as you know, I shared with the group, I'm now a pilot. I got my drone license.
Oh, I didn't know that. I missed that.
You missed that on Teams. So yes, I'm officially a drone pilot. Got my registration and I even registered my drones. I'm by the book. I have not flown since the rules changed in Canada, so I've always been by the book. So it was kind of fun to get out yesterday and do some filming yesterday.
Oh, when the virus is over, we should get the drone out and you can film the RC trucks doing some big jumps.
That'd be so cool.
That'd be so cool.
I'm going to figure out how to get the drone to follow things. We get the drone to follow the trucks around. Be a blast.
That'd be awesome.
So my daughter last week, get this, she applied for as people know, she was let go by the restaurant until things get back to normal. So she applied last week for the Canada Emergency Response Benefit, the CERB benefit. And it went through so fast and so easily. I got to hand it to the government. It's well done. Very well done.
Wow.
Like she did not have a CRA account yet. You don't have to wait for the password that you normally have to. It just went right through. Both of us could not believe how short and how easy it was to do.
Wow.
Which is good. I thought I'd also share a couple of Netflix recommendations. I don't think you watch a whole lot of this kind of stuff with the kids, but Ozark season 3 is phenomenal. Absolutely phenomenal. And someone's looking for another short documentary, How to Fix a Drug Scandal, is super interesting.
I heard about that, yeah.
Yeah, in Massachusetts, crazy. And then the one we watched yesterday, have you heard of this rowdy Ronda Rousey?
No, I remember when Ronda Rousey lost. Oh, I can't remember who she lost to, but she was very cocky going to the fight and she just got smoked by somebody. Does it talk about that in the
Yeah, that's how the show ends and you don't know what happens to her after. But man, she was an unbelievable athlete. So that was a great documentary. And a couple of books I mentioned in the podcast, Dan Gardner's Science of Fear, phenomenal book. And I also just started on the book called Stumbling on Happiness by Daniel Gilbert. So a couple really good books I'm reading right now.
Awesome. I wish I read books. I know I've said this before. You always read so many cool books. I just read the papers that we talk about later in the video.
Well, you read the papers, and I mean, you're a little bit busier with your kids than I am with mine, so I have a lot more free time, but I also started playing guitar again lately, so super happy about that.
I made wooden swords for the kids yesterday. We had some sword battles.
That sounds safe.
I sanded down the edges. It wasn't too bad.
Hey, have you heard of the cookbook How Not to Die?
No, sounds like a good book though.
So it's a cookbook that one of our clients who is quite thoughtful recommended. So I picked it up, and it's all about interesting vegetarian cooking, and the recipes look phenomenal. So I'm going to tackle that this week. I've picked out 2 recipes I'm going to make for the kids and I. Super interesting book, interesting ingredients.
Are you vegetarian?
I'm not vegetarian, and they don't promote being vegetarian. It's just, they say if you can just improve your diet by eating more whole foods and more vegetables, it's going to be better for you, but it's not some sort of new preachy type way of eating. And it looks the recipes look fabulous.
Interesting.
Yeah.
On a completely other dietary note, I made bone broth for Susan using beef bones.
Oh, Lisa loves bone broth.
I usually toss the fat, in the compost like you're supposed to. But this time I decided to keep it. So I all the fat that cooked off, I filled up a container, and it's called tallow beef fat, like rendered beef fat.
Yep.
And I've been using that to cook. It's great. But wouldn't fit with your vegetarian recipes, I don't think.
No, but it tastes great. Okay, anything else?
No, let's go.
Hope you enjoy episode 94. All right, so off the top, you wanted to talk about a webinar that you and I both watched last week featuring Edward Lazier, who is the Davies Family Professor of Economics at Stanford and is also a senior fellow of the Hoover Institution.
Yeah, so it's a webinar that Dimensional released. I think they've made it sort of available to the public now. Like we could give people access, I think.
But I think that expires pretty soon. So that's why we thought we'd do this little talk about the event.
Yeah, and that was the key, is we figured we could tease out the main insights that he had and talk about them on the podcast. But it was overall fascinating to hear. I find when you get outside of financial economics and into, he's a labor economist. This wasn't really all about labor economics, but you start getting in other fields of economics outside of financial economics, and it's just, there's so much other information and other theory that we never really think about or talk about.
And also it gives you an insight because he was an economic advisor to George Bush. And it just shows you the level of thinking. And he was one of a team of people advising the president. Incredible insights and education and brain power that goes into different policy decisions. Just shows you how much is going on. A bit of a background too. He is also an independent director on the boards of a number of Dimensional's U.S. mutual funds.
Right. So this is, I guess, why they had easy access to him to have him come and speak in the webinar. We're basically just going to talk about what he talked about. And maybe we'll add some commentary of ours if we can. But like I was saying, this is so outside of what we usually think about and talk about that I don't know how much we're going to have to add.
And again, this isn't to predict anything. I just thought, and I think you agree, it was interesting information from someone who observes this kind of stuff and advises governments on it.
But you know what? The prediction piece is fascinating because a lot of it is predictive. But one of the things that I picked up from him speaking is that for the type of things that he's studying, prediction is what you're looking for. I mean, I guess you could make the same argument when you're talking about stuff like small cap and value premiums. That's to an extent predictive.
Yeah, I guess I should have been clear. We're not trying to predict what the market will necessarily do coming out of this linked directly to the economic numbers.
Right. But the prediction that he was talking about, it's all prediction that would inform policy decisions.
For sure.
Which I thought was fascinating. So anyway, there are quite a few predictive statements in there. So he figures that the employment numbers predict a decline in economic output of around 25% for the quarter, just based on the numbers that are coming out now.
And that's when he talked about how this doesn't affect the whole economy. I think he estimated that basically 20 to 25% of the economy is affected, and so many professions are not affected at all. Like he gave himself as an example. He's a professor. He's not affected. School teachers and principals are not affected. So much of the economy is not affected by this.
He thinks that the decline will last one quarter.
Yep.
You can see all the prediction, and it's, like I was saying before, it's just fascinating to hear him making predictive statements, but it's all based on how can we make informed policy decisions using this information.
Exactly.
Like it's required prediction. So much different than trying to predict the stock market. I mean, not different in the sense that you can do it any better. Just the motivation's so different. Yeah, the disruption's not uniform, like you're just saying, Cameron. He said that transportation, leisure, and hospitality have basically shut down completely. And that's where he got that 20 to 25%.
I was amazed yesterday. I was out for a walk and I saw a plane fly overhead. And I just realized I have not seen a plane fly because we live near the airport. I've not seen a plane fly in weeks. It's incredible how it stands out when you see one.
Yeah, it's interesting. I have not noticed that. I don't see very many planes where I live anyway. One point that he made, I didn't know this, but the National Bureau of Economic Research, I don't know if you knew this or not, Cameron, they define a recession. You hear stuff like, 2 quarters of economic contraction or whatever. It's a committee. It's a committee that sits down and decides, yep, this is a recession. And there's no real quantitative definition of it.
I did not know that. And I went and did a little bit of homework on that this afternoon to learn more about that. But amazing. There are people that do this.
Yeah. So he figures that this will be declared a recession, but because there's no quantitative way to define it, that's not guaranteed. But I mean, realistically, it would be tough to imagine them not calling this a recession. And the other, I just wrote and we'll talk about this because we're going to talk about some of that research too, but I just wrote a video on the differences between the stock market and the economy. And in that research, I was reading also about the National Bureau of Economic Research. And in a lot of cases, they won't define a recession until more than a year or a year after the recession has happened. So you talk about it being a backward-looking metric. It's like, it's very, very backward-looking. But that was one of the person hosting the webinar asked Ed Lazear if this will be called, defined as a recession. And he's like, well, it's a good question because we don't always know what's going to be a recession and what's not. It's like, oh, wow. I actually didn't know that.
And it's only obvious in hindsight, of course. You don't really know it when you're in it necessarily.
And you don't know when it's going to end. That's the crazy thing about it because the economic data, well, we're kind of getting ahead of ourselves because I have a bunch of research on this for another section of the podcast. But by the time the economic data come out, it's like you're already in real life way ahead of that data. Anyway, we'll get back to that in a second. Ed Lazear said that we need to know the death rate relative to the number who have the disease in order to establish economic policy. And
that was fascinating. It gave me a greater appreciation for why we have to, one of the reasons why we have to do a lot more measurement of people to see who has been infected. And that's when he gave the example of Iceland that is, I guess, by far done a much better survey of the population and has found that 4 to 4.5 times more people were infected versus with the number that were identified as having it. So with more people having had COVID-19 and the same number of deaths, it means effectively the death rate is lower than we might think.
Right. And then he also talked about how as more people get the virus and recover, I guess, they become immune. We might be, even if we don't have a vaccine or anything, we might be more willing to open the economy back up. Because that risk
so fascinating.
Right. That risk of overwhelm.
To know like where is that point and how many tests have to be done to determine when that point will be.
Yep.
And currently doing 100,000 tests per day in the US, which he said is good. It's just not enough.
Well, this is
to get that decision point.
A week ago that this was recorded, or 2 weeks ago. So it could be more than 100,000 now. This is a little out of date by the time our podcast comes out. But yeah, 100,000 per day. But he said that's not where we need to be. I don't know. I didn't check where we're at now or where they're at now. The webinar host asked, where are we at in terms of the recovery? Which is interesting to think about, especially when you look at what the financial markets have been doing. I mean, they're down a bit today when we're recording this, but for the last week, they were, well, ridiculously good, which a lot of people wouldn't expect. And so Lazear said that he likes to feature, these are the way he described it, he likes to feature changes in the S&P 500 as the best predictor of future economic growth rates. He said he's not as comfortable using that in this period specifically because the models that feature the S&P 500 are based on normal times. And obviously these are not normal times. But he said based on these models, and he didn't specifically refer to which models he was talking about, but based on these models, the changes in the S&P 500 so far say that we would have a negative 0.5% growth over the next 4 quarters. And he thinks that's optimistic. He said he doesn't think that we'll do as well as that. And we being the US, he doesn't think the US will do as well as that, but it might be close.
Can you imagine coming out flat, basically flat for the next 4 quarters?
Right. And they talked about how this is a supply-based recession because we've shut off a supply of business activity and labor.
And it's been incredible. Like you look at how little I know our household is spending, for example, because we've just been shut off basically from the marketplace, from travel, from eating out, from so many things. Even simple things like flipping our snow tires off the cars. It's incredible.
You didn't flip them?
Not yet. Going to.
I've got an appointment next week. Should I go?
But sure, you should go. You got to get them flipped. But I mean, we have we have very low gas prices here in Ottawa. For the past month since we've been working out of our house, I filled up the other day for $12. I just topped it up at Costco.
Crazy.
Whereas normally that's a few days of gas in our world.
Well, talking about that demand piece, Lazier said, imagine what would happen if tomorrow we did have a 100% effective vaccine and could inoculate the entire population, because obviously you couldn't do that quickly. But he said, imagine if that happened. He expects there's going to be a ton of demand. So whenever this thing turns around, or we decide people can go back to work and go back to normal, he figures there's going to be a ton of pent up demand.
Yeah. And you read lots of comments on Twitter saying like the world has changed forever and we're all going to be different people going forward. And that may be the case. I'm not so sure. I'm curious to look, 2, 3, 4 years in the future to see how our lives have permanently changed because of this.
It'd be fascinating to see what the world looks like.
Certainly a whole lot more respect for the risk of a pandemic.
That is for sure. So this part I thought was really interesting, and it speaks to what the governments have been doing. And he was very careful. He doesn't like to call what the governments have been doing in terms of fiscal policy. He doesn't like to call them stimulus packages because they're not stimulating anything. He called them liquidity packages.
Absolutely.
But so his comments on, if we get the disease under control, the economy is going to go back to work quickly because there's going to be a ton of pent up demand. He says, but there's a caveat. That's only true if we can avoid major economic disruption in the interim. And it's basically like, if businesses shut down, if there's a ton of bankruptcy, then things are not going to go back to normal quickly. But if the government's able to use the programs that they've been putting out to keep businesses afloat, so that as soon as things go back to normal, businesses can fire up again very quickly, then he thinks it's going to be a fast recovery. But it's getting from here now to things going back to normal without having all those businesses go bankrupt.
Right. Because going bankrupt ends up becoming much more expensive for the economy than trying to get through this with a stimulus package.
Correct. And he gave his experience when he was working in the White House for President Bush, and Bush decided to bail out the auto industry. And he talks about the logic behind that decision was it allowed for a Chapter 11 bankruptcy instead of a Chapter 7. And so I'll explain what those mean because we're not American. Chapter 11 is a negotiation between the business and its creditors. So that's what they ended up being able to do. Whereas a Chapter 7 is a sale of the assets, outright sale of the assets to pay the creditors. And so he said, from an economic theory perspective, and just logically too, it makes sense. Getting the assets from the auto industry back up and running in a Chapter 7 would have been very hard. If they sold the factories, sold the inventory, whatever, it would take a much longer time to get those assets to be productive again.
You can't even imagine how long that would take.
Right. So the government looked at this and probably did a bunch of modeling and decided it would cost the government less to do this massive bailout than it would for them to lose all the associated revenue with the productivity. I've kind of heard that thinking before, but it was fascinating to hear somebody that was directly involved and responsible for thinking about it. It's fascinating to hear him explain it. He's a big fan of what Powell's been doing with the Fed. Thinks it's been well designed and the action's been very quick. And I've heard that from a few other sources too. In general, supply-based recessions, which he says this is, tend to be more V-shaped. And he said, and this was interesting to me because I would not have drawn this comparison, but it does make sense. He said the best example to compare this situation to is World War II.
Exactly.
And I was like,
because back then, so much the labor force was taken out of work when they went to war.
Exactly.
And when they came back, everything ramped up so quickly. So I thought that was a great comparison.
Yeah. And at the time, people thought that it was going to be damaging to the economy to have such a supply of labor, but it ended up, not being. And there was a massive bull run and economic boom afterwards. And then this is another fascinating example. You're trying to think of an example, and you think about 1918. And 1918 is a good example in terms of the narrative, but in terms of the actual economic outcome, it's very different. At that time, everybody's in the middle of World War I. Well, you have the influenza pandemic. But I mean, you have a recession, you have a stock market crash, so it seems like it's very comparable. But when you hear an actual economist talking about what this should be compared to, that was not one of the examples that he gave. So anyway, the other example that he said is worth looking at is reorganizations of economies. And that's like, yeah, I would not have thought of that. But he talked about a command economy, which is like a communist type situation, an economy that's organized by a centralized government that owns most, if not all, of the business assets, and whose officials direct all the factors of production. So North Korea, former Soviet Union, versus a market economy, which is like a free market type situation, which is not organized by a central authority, determined by supply and demand of goods and services. So that's like the US and Canada, obviously. So he said that when a command economy changes to a market economy, which we have historical examples of, there is a period of disruption where the whole economy changes. And then once things get reorganized, there tends to be massive growth. So we talked about Chile and the former Soviet Union as examples of this. Mm-hmm. And then in terms of monetary policy, and this was interesting too, and this came up in that, when we talked about all the historical bear markets in a previous podcast episode, this came up in that research. He does not think that monetary policies will tighten up after this quickly. And he said central banks are terrified of repeating the 1930s recession. So that's where they had the 29 crash, terrible, terrible recession. And then when things started to get better in 1937, there was a major tightening of monetary policy. And that arguably caused the big recession that they had in 1937. So he figures the Fed's going to be very cautious. And he thinks this is why Yellen was very cautious in raising rates after 2007. Central banks, he said, they're nervous of repeating that example. So Gerard O'Reilly, he was the host of the webinar, that's Dimensional's co-CEO, who's scary smart. But he kind of chimed in at one point in this webinar and talked about financial markets and recessions. And he had some pretty interesting data points. He said stock returns tend to predict future economic growth, but those predictions are a lot noisier in times like this, I guess, volatile times.
Right, because they're pricing in all the information that's being fed to the markets.
Right. So he gave some data points starting in World War II, so from 1945 to now. And he used the NBER definitions of economic peaks. So that starts with a recession. So there's been 12 economic peaks from 1945 until now. The average recession is 11 months over that time period. The average excess return of stocks over the full period, stocks over bills, has been 65 basis points monthly. So for that full period. And then he said during a recession versus an expansion, the 3 months around the peak, so that's the 3 months before the start of a recession, or at the start of the recession, excess returns tend to be negative. And then around the trough, they tend to be positive. So he said for the peak in the following 2 months, so the peak, this is when the recession starts, the economic peak, the average equity premium tends to be negative, or on average, is negative 2.2%. So full period, average excess return, 65 basis points, positive for stocks. And then for the peak and the 2 months following the peak, the average equity premium is negative 2.2%. And then for the
if you know when the peak is, of course,
well, which you don't, and even NBER doesn't release it until up to a year or more later. And then in the trough, so this is the end of the recession, and the 2 months after, the average equity premium has been positive 3.2%. So his commentary is that they're at the peak, around the peak, and around the trough, there are these big premiums, negative and positive. So then the remaining months, and this is in the recession and the expansion, the remaining months, except for those month and 2 months following the peak and the trough, the average equity premium was about 70 basis points. So recession, expansion, whatever you want. So it's really just those key peak and the 2 months after the peak, you have a negative average equity premium. But then at the trough, at the end of the recession, which in both cases, we don't know when that's going to happen, and the economic data won't tell us until way afterwards, but you've got these big positive premiums around the peak, around the trough. And then all other months, 70 basis points on average, including during the recession.
It's interesting how all this data is around data points that are only identified long after the fact by NBER.
Right.
So it's not like you can pivot your portfolio around these as it happens. These are all backward-looking data points, obviously.
Yeah. And they talked a little bit about, and this, now that I'm rereading my notes here, that this may have been what inspired the video and one of the topics we're going to talk about later. But he looked at the GDP growth of countries and compared stock returns of high versus low GDP growth countries. And this is actually different from the paper that I refer to later. So I don't know what time period he was talking about. But he said that the return differences of those two groups have not been reliably different from zero. So GDP growth, not a good predictor of future stock returns. Although, as we'll talk about later, other research has shown there is a negative correlation.
And I think that statement will shock a lot of listeners.
Yeah, I would agree. And this is still Gerard. Ed Lazier talks again, but there's one more comment from Gerard. He said that you should not change based on those equity premiums around the peak and the trough and all other months. He said it does not make sense to change your asset allocation because you think that you'd have new information about expected returns. You don't. Unless you can predict where the peak and the trough are, expected returns are basically the same in every other month. So there's those few months where equity premiums are a bit different. Other than that, they're pretty much the same on average. So back to Ed Lazier talking. He said that in an optimistic scenario, we make progress in treatment, vaccine, and or disease identification. We would see a major contraction this quarter, and then hopefully within 6 quarters, we'll be back to normal. So that's his optimistic prediction. But, and this comes back to his comment about the fiscal policy piece, this assumes no major business failures. And he thinks the government is doing what they need to be doing to avoid that from happening. And globally, governments are doing similar stuff. He said the fiscal policy packages, liquidity packages around the world have been similar to what the US is doing. Inflation, and I thought this was fascinating because I've heard a lot of people questioning this. With all these governments raising all this money or printing all this money, however you want to describe it, people are worried about inflation. He said he's not worried about inflation because there tends to be inflation when everything in the economy is tight in terms of, I guess, labor supply and demand. He said right now there's a ton of slack in the economy. So there's going to be no need to raise prices.
That's interesting, right? Because so many people are worried about so much stimulus causing inflation.
Right. So he said in the early stage of the recovery, jobs start to come back, unemployment falls, and it's at the peak capacity of the economy when we might start to worry about inflation. But at this point, he said that's not even a little bit of a concern.
Well, it's going to be fascinating to see how this all plays out, no doubt.
Oh, of course.
I mean, the human side is obviously way more important, but you combine the human side with, I mean, it's like this grand experiment, right? To shut down the entire economy and see how it does restart again, and hopefully restarts and everyone remains healthy so we don't have to shut it down again. It's going to be an incredible thing to witness.
It's historic for sure. It'll be studied for many years to come, no doubt.
Anything else you want to add to that?
No, I just thought it was a different perspective. Like you had Gerard's points in there, which is the kind of stuff we usually talk about, the empirical data around stock returns and the economy. But to hear an economist talk about, and it's actually interesting just to point out that Gerard is not an economist; he is a rocket scientist. Anyway, but
literally,
literally, I know. But to hear an economist talking about how he's thinking about this and what he's seen in the past and how it relates to past events, I thought was just a really unique perspective.
So on to a news item this week that I came across. And this one came from a Bloomberg article, and I've heard it mentioned a lot since I saw the article about how State Street, which is a massive ETF provider, is delaying rebalancing some of its biggest ETFs since the index provider, Standard & Poor's, announced that it will be postponing its quarterly rebalancing from this March. So this past March, they've deferred it to June 19th. And this is a big, big deal. So there's a bunch of indices that had their rebalancing delayed in March by a week or two. But this one affects, I believe, over 60 of State Street's ETFs, including the massive $250 billion SPDR, SPY, which is the S&P 500 ETF. And the reason given was they have concern about the volatility surrounding the markets during the pandemic, which can lead to increased costs of trading. And they also attribute it to the uncertainty of global market closures. So I came across an article just doing some more research into this from Vanguard on their site. And they were actually asked for input into this decision to delay the rebalancing. And from their website, what Vanguard said was that they believe that it is presently in the best interest of our investors to delay index changes until conditions normalize. So the crisp March rebalance was also deferred to June. Russell, another index provider, said it's business as usual. The FTSE appears to be normal this quarter. And the MSCI, the next scheduled date is May 29th. So it's business as usual for them.
You'd love to see how much this is affecting the characteristics of the funds tracking these indexes, like relative to what they would look like if they were rebalanced to their ideal characteristics for the index. What do the funds actually look like?
Absolutely. I mean, the example that Dimensional always uses is a haircut example. So if you get your haircut once a year, for the last few months, it's getting pretty long and shaggy. So you're only brought back to the way you want to look once a year. Whereas if you're cutting your hair every single day, your hair always looks perfect, right? Well, the same goes for, especially say a small cap or a value index, where those can change dramatically the makeup. So you could even make the argument that even doing it quarterly is not necessarily optimal, because only at the beginning of the quarter are you properly in line with the kind of haircut you want.
And you can see that a bit when you look at the rolling regression data. I did a blog post a while ago comparing building a tilted portfolio, small cap and value tilted portfolio, using Vanguard versus using Dimensional. And in terms of factor exposure, you can get pretty close. But when you look at a monthly rolling regression, like what is the factor exposure each month, it's not bad. Like Vanguard still looks okay, but the standard deviation of the regression coefficients is higher in the Vanguard portfolio because of the less frequent rebalancing, whereas Dimensional is obviously implementing every single day. But that effect will be more extreme in this case.
It's one of the things I was wondering, because we know that a lot of hedge funds trade around these reconstitution dates or rebalancing dates. So I found an article in Forbes titled, "Hedge Funds Suffered Losses as Index Rebalancing Trades Went Awry." So a quote in the article said, "The postponement of the rebalancing of hundreds of equity indexes set off a stampede among computer-driven hedge fund operations that have been preparing for the event." So, for years, hedge funds have been making profits off the anticipated changes in the index reconstitution. Probably the most obvious one would be, the Russell series, the Russell 1000, 2000, 3000, because they're strictly rules-based.
CRSP is pretty similar, I think.
Absolutely. Yeah. Good point.
Yeah.
Another comment in the article talked about how do you figure out what sectors might be added to an index, because the S&P index, the 500 index, is much more subjective. And the example they gave was that since IT has done so well, maybe the indexes need more IT exposure. So they may, the hedge funds may try to predict who will be in and who will be out. So the quote here in the article says, "A lot of people lost a fair bit of money trying to position for that stuff," said a hedge fund employee that was hit with losses. "It was such a tail event and not in anyone's consideration that it could be postponed. Nobody remotely considered this would ever happen."
Just another reason it's hard to predict stuff.
Yeah. Yeah, exactly. Okay, so on to our featured topic. One of the featured topics that you want to talk about, the portfolio topic, which you wanted to compare and contrast the stock market with the economy.
Yeah. I just see so many people being like pulling their hair out, saying, "Oh, this terrible economic data were released, but the stock market went up. Like, how does this make sense?" And people are saying that's a reason to say that the market is not efficient and it's completely irrational and it's rigged. I'm going to do a video on that too. Is the market rigged? It's not.
Well, it's a screenshot I shared with you on March 30th, I think it was, that had the great big title, coronavirus job losses could total 47 million people. This is in the US. Unemployment rate may hit 32%, Fed estimates. And then on the top of that screen, the Dow was up almost 700 points on the day.
Right. So that's one of the first points for this topic, is that Canada lost 1 million jobs, a record just over 1 million jobs in March 2020. And this was released on Thursday last week. And what did the S&P TSX do when that data was released? It closed up 1.75% or something. And so that's the kind of data point where people look at that and say, "Oh, the market's completely irrational." But the thing that I don't know if everyone's properly thought through, if you're pulling your hair out wondering how could they be so disjointed? The explanation is fairly simple. It's that the stock market is a forward-looking pricing machine. The stock market's pricing in future expectations about cash flows and risk.
Exactly.
And economic news, like we just talked about for the Lazier webcast, economic news is backwards looking, and sometimes like far backwards looking. By the time we have the data, it could be, in the case of the recession definitions, more than a year old. So when stock investors are investing in stocks, what are you getting? You're participating. You're getting the rights to participate in a company's future profits. And in an efficient market, like I just mentioned, stock prices contain information about future profits and risk, forward-looking expectations. And so when you think about economic news, it's already in the price. The expectations of economic news are already in the price. So if we use the example of the employment numbers, that really bad expectation for huge job losses was in the price. And those numbers come out. The thing that we don't know and can't know is how the data that are released are going to compare to what the market expected. That's unknowable. But if the data come out, and even if they're worse than, what an analyst had predicted, that does not mean that they're worse than what the market expected. So in this example, you could make the argument that even though the job losses were, record high, they weren't higher than what the market was anticipating. Now, that's just that in isolation. There could have been other factors like the US stimulus or liquidity packages that could have affected the stock market that day too. But in isolation, that would be one of the ways to explain that.
And the handful of clients that I've spoken to that chose to go to cash recently, and it's very few, the reasons are always similar. And even I look back past crises where people made that decision, whether it was 08 or 01 or, the late 90s, the reason is always the same. It's bad out there. It's going to get worse. I've been watching the news. My question back is always the same. Like, well, what have you said that others don't know? No one has any original new information.
Yeah.
And just because it looks bad doesn't mean that it's going to stay bad. And it doesn't mean that terrible news hasn't been priced in the market already. But so many people aren't able to make that leap somehow in the logic.
You'd expect big further declines if there were major unexpected economic events. Like what would be I don't know what an example would be. A natural disaster like an earthquake or something. Maybe that would be.
Well, that was one of the examples you gave a couple of weeks ago.
Right. And that sure. If we want to think about how much further down could the market go, now the current pandemic situation could still get worse.
Absolutely. We're not saying prices are right.
Right.
Absolutely.
But it would have to be some major unexpected thing. Like the I don't know, mortality rate ends up being way higher than anybody ever anticipated, and that data starts to come out. Yep. That could have a big negative impact.
Yep.
Or a natural disaster, like I said, like a massive earthquake destroys, half of North America. That would probably have a big impact on stock prices, not to mention the human impact. So I think the main point to drive home there is that whether economic news like jobs numbers or GDP numbers or whatever, whether that information is good or bad, in absolute terms, 1 million job losses is bad. But in terms of how that would be expected to affect financial market prices or stock prices, it only matters how good or bad that news relative to what the market expected, which is unknowable ahead of time. So I thought there were two good case studies that we could talk about, not including the current one because we don't know how it ends. So the US through the global financial crisis is an interesting one. Can you hear my kids in the background?
Yes, we can. It's awesome.
We'll leave that in the audio. So the US market started to decline in October 2007, which is 2 months before. Like you just think about that leading versus lagging idea. So 2 months before the stock market started to decline, 2 months before the National Bureau of Economic Research defined the economic recession as having started. So the 2007 recession, Ember defines it as starting in December 2007 and ending in June 2009. Now, like I mentioned earlier, those days were not announced. And I find this so interesting. They were not announced until December 2008 for the start of the recession. So a year after it was determined to have started. And September 2010 for the end of the recession, which is more than a year.
Incredible.
Yeah. It is. It is. And then, like we mentioned earlier, I know I'm repeating myself, but it is interesting. Those dates are not quantitatively determined. It's a committee that has probably a Zoom call and talks about, I don't know, the kind of stuff that Ed Lazier was talking about and decides whether or at what date the economic peak happened.
Yeah, the business cycle dating committee.
Yeah, it's just fascinating. And we think about, so we're in this recession that was declared a year after it started. So May 2009, or since May 2009, U.S. unemployment had been above 9% and reached a peak of 10% in October 2009. And real GDP in the U.S. reached its low point for this recessionary period in the second quarter of 2009.
Right. So that's when the market has started to pick up.
That was the bottom. That was the bottom. But
bottomed out in March of 2009.
But this is the crazy thing to think about. It bottomed out then, but the committee decision declaring the end of the recession didn't come out until September 2010. So you're seeing unemployment is getting worse. GDP has continued to fall, and it reached a low point, but we didn't know it was a low point at the time. And nobody has come out yet and said the recession's over because they didn't know. And it wasn't until more than a year later that they actually had the numbers to say this is when it ended. So you imagine being an investor at that time. Economic data is continuing to get worse. Like, why would you think that things were going to get better, that they were getting better?
Right. That's what we often hear too. I'll buy back in when things look better.
Right. Then you look at the stock market. February 2009 was the bottom. So unemployment reached a peak in October 2009. So it was just getting worse and worse and worse. Unemployment's getting higher until October. And GDP is continuing to drop. Second quarter 2009 drops again. But in February 2009, that was the bottom of the stock market. And then we kind of know the story after that, where there's a major rebound. So it's like you said, Cameron, yes, things could get worse from an economic perspective. And they often do. And in this one example, they continue to get much worse. Meanwhile, the stock market's rebounding. But you can just hear the people saying the market's irrational, this doesn't make any sense. But the market's forward-looking. So in this example, from that bottom in February 2009 to the end of that year, the stock market was up 56%. And then we kind of know what happened after that. It kept kind of mostly going up until sort of 2018, but really until recently for a proper drop. Yeah. So the theoretical explanation would be that, well, I guess the market was expecting them to be worse. And when they came out as not as bad as expected, the rebound started to happen. And by the time things were getting better, the market was already well into its rebound.
Yeah, you wonder how much of that is just pure bandwagon, people jumping on the bandwagon as it starts to come back.
Who knows? I mean, to me, it's just crazy to think about. I'm imagining being an investor, seeing in October that the GDP's dropped again and thinking, geez, like it's just getting worse. But by October, you've missed a good portion of the recovery.
Huge amount of the recovery.
Yeah.
And it's also a testament to the ability and the devotion to rebalancing through that, right? Because I remember in early 2009, like January, February, it was ugly, right? And I know we've talked about this in the past, but to stick to the discipline of continually rebalancing, so you're buying more equities as things are looking ugly. And I can tell you, it was not obvious in March of 2009 that things were going to turn around then at all.
Having a sample of both in this downturn, having a sample of portfolios that we manage that are still made out of components and ones that are automatically rebalancing. The automatic rebalancing experience is, in my opinion, from the client's perspective, phenomenally better than having to think about, should we rebalance? When do we rebalance? How much do we rebalance? What's the trigger?
Yep. And you get big swing days, like 3%, 5%, 8% swings in a day or in a week. Your portfolio could be off its target mix in no time.
Yep. And then you rebalance and it's off target in the other direction. It's not easy. So then the other example I thought would be worth walking through, and this is a paper we've talked about before, so I hope people aren't bored of hearing about it, but it is a great paper. It's the 2018 paper from Fama and French, Inverted Yield Curves and Expected Stock Returns. And it's just, again, that relationship between economic data and financial market performance, stock market performance. So they in their paper fully acknowledge, and a lot of that acknowledgement comes from Fama's past empirical research, that the yield curve tends to forecast economic activity. So looking at the yield curve inversions does tend to forecast economic activity. And this one, it happened this time, but yes, the yield curve inverted, and yes, there was a recession afterwards, but we also nobody was expecting the coronavirus. Like when the yield curve inverted last year, it didn't invert because of the coronavirus. I don't think. Maybe the yield curve knew more than everybody else. I don't know. Anyway, that's just an interesting sidebar. So yield curve inversions do tend to forecast economic activity, and they built a market timing model to see if shifting out of equities and into treasuries when the yield curve inverts adds value to portfolio returns. So can you generate an active premium by using the yield curve to predict future stock returns, basically? And their conclusion is we find no evidence that yield curve inversions can help investors avoid poor stock returns. And then they explain that the simplest interpretation of the negative active premiums we observed is that yield curves do not forecast the equity premium. And that is an interesting point because they do forecast economic activity. Empirically, we know that, but they do not forecast the equity premium.
Wow.
Yeah. And you just think about how that relates to what we were just talking about with that anecdote about the US market. And that their example is, I think they built 3 different portfolios. I'll botch it if I try and say it, but I think it was like US. No, I got it. US, World, and World X US. And they used local yield curve inversions. So not just US, they used the yield curve in each local market to shift in and out of equities. So we gave the anecdotal example of the US, which I thought was interesting. But Fromm and French looked at all over the world using a whack of data and found the same thing. I thought that was pretty interesting. I think in the short term, it should not be a surprise when economic data and stock market returns seem disjointed. And it can go both ways. Like, I think we're kind of focusing on the example of bad economic data and good stock returns. But you could also have good economic data and bad stock returns. It's kind of like company earnings releases. You could have really good earnings release and bad returns.
Absolutely.
It's kind of similar in a way. You can't think about what's the relationship between the stock market and the economy. It's not about what's happening in the economy now or what data we're getting now. It's about what's happening relative to what the market expected to be happening.
It's all about expectations.
But it's not bad economic news paired with good stock market returns does not mean the market's irrational. Someone actually tweeted at me today showing an image kind of like the one you were talking about, Cameron, with, like massive job loss numbers, but best 1 week market return since 1930 or something like that. And they said, I think we need to talk about the efficient market hypothesis. That was the tweet. And it's like, no, I don't think we do.
Yeah, no, I'm not sure you'll engage on that.
No, I didn't. I might. So that was in the short term that we just talked about. Short-term economic data. Over the long term, I found a bunch of interesting research also. So if you think about GDP, which is a pretty good way to describe a country's economic output, and you think about what's going on now, what if we do have a slow economic recovery? What if GDP does decline and take a long time to ramp back up? And you think about, okay, what is the relationship between GDP and stock market returns? So you'd expect, this is maybe obvious to everyone, but in normal times, you'd expect an economy like China to have a faster growth rate than an economy like Canada or the US, more developed markets. And maybe China's not even that good of an example anymore because they've gone through a pretty rapid expansion. There are probably other, Eritrea. I'll just throw that one out there. They probably have a really high growth rate. And then obviously a big economic event like a country shutting down everything, well, not everything, but a lot of things, would be expected to have a big negative impact on GDP. You mentioned earlier, Cameron, this is something that a lot of people wouldn't expect. You'd expect a rapidly growing economy in terms of their GDP growth rate to have higher stock market returns.
Absolutely, you would expect that.
And lower GDP growth, you'd expect to have lower stock market returns.
People can't hear this, but I'm nodding like crazy because this comes up all the time.
Well, if we release the video, we're recording on Zoom, so maybe people get to see you nod.
See me nodding. We'll see if the video turns out between your kids and my dog. We don't know if this is going to work or not.
Well, that's the audio. If we're not keeping that, then no one's going to hear this episode at all. Okay, so I found a paper. I found 2 papers, and I messaged on Teams, the Microsoft Teams, like our Slack thing that we're using. I messaged our director of research saying I was researching this topic. Does he have any papers? And he pointed me to the two papers that I was already reading. So my conclusion from that, me finding these as the leading papers and our director of research saying these are leading papers, seems to me like these are probably the leading papers on this topic. So one's a 2012 paper by a guy named Jay Ritter. He's done a bunch of research on IPOs too. I've referenced his stuff in a video in the past, and we talked about that in the podcast too. So his 2012 paper titled, "Is Economic Growth Good for Investors?" And you can tell from the title, it might answer our question. So he looked at the relationship between GDP growth and stock returns. And he showed for 19 mostly developed market countries from 1900 through 2011 that the cross-sectional correlation between the compounded real return on stocks and the compounded real growth rate per capita GDP was negative 0.39.
Boom.
So negative correlation between GDP growth and stock returns.
Wow.
And then he also looked at a sample of 15 emerging market countries for the 24-year period. So that last period, 112 years, that's a big data set. This one's less because there's less data. But this time it's a 24-year period from 1988 through 2011 for 15 emerging markets, including Brazil, Russia, India, China. And he again found a negative correlation between economic growth and stock market returns of negative 0.41. So actually very, very similar negative correlation.
Wow.
So
the evidence clearly suggests countries with stronger economic growth have had lower stock market returns. Like, let that sink in for a bit.
Yeah. Yeah.
That is so counterintuitive. Like, we've known this. I've known this for a long time, but I'm sure a lot of listeners don't know that.
I knew it to be true empirically. I can't say that I had dug into the research on why it was true.
Right.
Because why would you think about that? I accepted it as fact from empirical data and just figured, whatever, that's the truth. Like, why would you not invest in China? Well, because GDP and stock market returns aren't predictive. Or GDP is not predictive of stock market returns. But I never really thought that there was a robust body of research on this. Okay, so the theoretical reasons for why this happens, one of the main ones is it's kind of like what we just talked about with economic data. In an efficient market, and everyone's going to say, well, the market's not efficient. Whatever. In an efficient market, investors build expectations into prices. So if you invest in an expected high growth country, that growth should be priced in to, into stock prices. And if that country ends up realizing the expected economic growth, you're going to collect the equity risk premium.
Yep.
If the economic growth is less than expected, if it falls short, well, you're going to realize less than, a normal equity risk premium or a smaller premium, however you want to think about it. Now, if we take the empirical data showing that there's a negative correlation between economic growth and stock returns, you could think about that. And I think Ritter mentions this in his paper. You could think about that as people have historically overpaid for expected growth, which is what's resulted in that negative correlation. And you look at China as an example. Maybe people invested in China. I looked at the stock returns in China from 93 until now. I don't know if I have the data point, but they're terrible. Terrible. Like, you're better off in T-bills, I think. And why would that happen when they've had such crazy economic growth?
Expectations.
Correct. One theoretical reason is expectations were higher than what actually happened. Even though the economic growth has been fantastic, people expected it to be higher. So then the other big theoretical reason that I took note of, there were a couple of others in Ritter's paper that I wanted to keep it concise. And this is one of those sort of main papers on this topic that I found. So Ritter mentions it, but the main paper is by Rob Arnott and William Bernstein, titled Earnings Growth, the 2% Dilution. And so they talk about this thing called slippage, which is the shortfall, and this is their definition, the shortfall between economic growth and growth in earnings per share.
Okay, so let's go through this carefully. This is really important.
Okay. So as a stockholder, growth in earnings per share, or I guess growth in multiples of earnings, are what result in stock returns for an investor. Growth in earnings of the market as a whole don't necessarily benefit you as the investor holding shares in a company. If the market-wide earnings are increasing, but the earnings per share of your company are not increasing, you don't necessarily benefit. And that difference
how can that happen? Because there's more shares issued?
There could be more shares if issued from your company that you're already investing in, or there could be more shares issued from new companies that are selling their shares on a stock exchange, going through an IPO. So you think about that as from the economy perspective, that's economic growth, measurable economic growth. But then you think about that as an individual shareholder perspective, the earnings per share of your company are not necessarily increasing, at least not at the same rate.
Right.
So Arnott and Bernstein, in their paper, they showed in a chart that corporate earnings and GDP have been directly related going back to 1929, with aggregate corporate earnings making up a constant 8 to 10% of GDP. So corporate earnings increasing at the same rate, or increasing with GDP, making up a constant percentage of GDP. But then there's the slippage. So the growth in aggregate earnings has not directly benefited investors because of the earnings per share issue that we just talked about. And this is the point, one of the main points that they make. Per share earnings growth can only keep up with GDP, and this is what you just mentioned, Cameron, if no new shares are issued.
Exactly.
We kind of went through this already, but it's worth maybe reiterating. If you own shares in a company and a new company goes public, for you to participate in the earnings of that new company, you'd have to sell some shares in the company that you currently own and reallocate to this new company. So for you, as owning a portfolio of assets, new listings or new equity issues from existing companies do not result in portfolio returns automatically, but they result in economic growth.
Right. Bigger pie, but more slices of that same pie doesn't increase the value per slice.
Correct. And for this one, China could be a good example, because a lot of the growth in the market value of their equities, like their stock market capitalization, has grown tremendously, but a lot of it has come from new listings. I don't have the data, but I would even go out on a limb and say it's probably a substantial portion, maybe even a majority of their growth and capitalization has come from listings as opposed to growth in existing listings. New listings as opposed to growth in existing listings. So if you're an equity investor in China, the market capitalization's increased, the economy is increased, your investment returns have not increased commensurate with that growth because a lot of it's come from new issues.
Yep.
Which you would have had to reallocate capital to get access.
Exactly.
Yeah. And then Arnott and Bernstein give an interesting example. As opposed to looking at emerging markets or something like that, they looked at war-torn and non-war-torn countries from 1900 through 2000. And 2000, this paper was written, 2001 or something. It's an older paper. So they showed that war-torn countries had their economies devastated by war, but within a generation or less, or a generation or a little more, their GDP caught up and in some cases surpassed the GDP of non-war-torn countries. But then this is the fascinating part, is that the war-torn countries' so GDP catches up, keeps up. But the stock market growth trailed their economic growth by nearly twice as much as the non-war-torn countries. And the explanation that they give, based on what they're talking about theoretically in the paper, is that those war-torn countries had this massive economic growth, but it was also a massive recapitalization. So surviving companies had to raise a bunch of new capital. New companies obviously had to raise capital. So if you're an investor, if you own the index in Germany or something, you're not necessarily participating in their massive economic growth because so much of it is coming from new equity issue. So it's kind of those two things working side by side. In a higher growth economy, you might have people more willing to overpay, leading to lower returns in the future if economic growth is only as good as expected or worse than expected. And the other mechanism that you have working against you is that a higher growth economy will generally have more companies raising capital, whether that's existing companies raising new capital or new companies.
That is it right there. You're absolutely right.
Yeah. Yeah.
Fascinating.
And there's a piece about buybacks in there too that you asked me about, Cameron, when we were talking about this offline, like how do share buybacks fit into all this? Because if a company's buying back shares, that should be increasing the earnings per share of that company, which is true. But in aggregate, across the whole entire market, it's net share issuance that matters.
For sure.
So if companies are buying back their shares, that's increasing the earnings per share of that company. But if other companies are issuing a ton of new equity and it nets out to be positive net new equity issuance, you're still going to see that slippage. So buybacks don't. And that was actually the basis of their paper. They were talking a lot about what caused the tech bubble. And they were saying that people were misunderstanding how buybacks would affect stock returns. They're thinking buybacks would make stock returns be able to go infinitely high. But in reality, that's not true in aggregate. It's net issuance, not issuance for an individual company that matters to the market as a whole. So to wrap that topic up, in the short term, price changes are driven by expectations about the future. And expectations change very quickly, especially in times like we're in now based on new information. But what we cannot know is how that new information is going to line up with what the market expected. And it's only that. How do those two things match up? That's what's going to drive big changes in stock returns. So that idea of, I expect things to get worse, so I don't want to invest or I want to take my money out. It's like, it doesn't matter if things are going to get worse. They might not. What matters is...
do you think they're going to get worse than what the average investor thinks?
That's the key.
And you have no way of knowing what the average investor is thinking.
Yeah. And in the long term, I thought that data was fascinating too. It's like, we start thinking about, okay, maybe the developed countries are going to go through this big economic slowdown because of what's happening right now. And this is going to be this tipping point, and maybe emerging markets are the place to invest now because they're going to have higher GDP growth after this. Doesn't matter. GDP growth, historically, it's been negatively correlated. Correlations are notoriously unreliable, but historically, you're better off investing in lower GDP growth countries. Yeah. So anyway, I think that paying attention to economic data, like that, the Ed Lazear stuff we were talking about, fascinating. I love listening to that and hearing about it. Does it matter from an investing perspective? No. Does not add value. It's not going to allow you to make better investment decisions.
No, those data points don't, but understanding the interplay between those data points and what actually happens is what's so fascinating.
That's a good point.
And to realize that the market's a pretty smart place. There's a lot of smart people there. And I think the fact that it is moving around so quickly lately, or as always it does, just shows you how efficient it is at pricing in the information so quickly. And
not the other way around, which is it's the thing I keep hearing people say, that the market's rigged and broken and all this stuff.
I think, for a typical portfolio to be down, whatever, 15, 20, 25%, depending on your asset mix, considering what we have gone through, and to know you have a portfolio that is mark to market all the time that you can get out, I think it's pretty remarkable.
Yeah. That makes me think, what you just said makes me think about real estate. Like, as far as I know, I don't think real estate prices have changed too much, but the data are lagging and there's no transactions going on.
Private equity.
Like, go try and sell your house right now. See how much you can sell it for.
Yeah. I don't know.
I don't know either.
Anything else to add to that topic?
No, I think that's good.
Okay, so let's go on to the planning topics. This is something I've been digging into a lot lately, which is determining your risk tolerance. And this is certainly very topical of late. And what really prompted me to think more about this, I've been reading Daniel Gardner's book called The Science of Fear. So he's a local writer, terrific writer, and professor at Ottawa U, and also worked for the Ottawa Citizen for years. So this book is fabulous on how humans process risk and how so many decisions are made irrationally that can lead to, as he puts it, unintended consequences. So the example he gives, and I've seen it in a number of talks he's given online, is, after 9/11 and the horrible events there, many people took up driving instead of flying. Well, that led to an additional 1,500 road deaths that were not expected. So there's a horrible unintended consequence where people didn't judge the risk based on data. It was more an emotional decision. And as we've all heard, humans are hardwired to largely fight or flight when presented with what is perceived as danger, much like in the markets of lately. And there's all kinds of dynamics going on in society today, such as we're getting message all the time. We're getting messages directed to us that feed into our own biases. That leads to things like tribalism. And I know we've talked about this in the past, with the Undoing Project and Kahneman's work in Thinking Fast and Slow, and how so many people, I guess all of us, make decisions usually with our system one thinking, which is that quick, intuitive thinking, as opposed to system two, which is more the sit back, analyze the information, make a logical, rational decision. It's interesting reading his book. I kind of come away thinking that, you are kind of the perfect example of someone who largely lives in the system two world, because you're, I think, more than many people, not affected as much by system one thinking, which is that emotional, perhaps irrational type knee-jerk type of thinking. And I know the point behind this podcast is to help people make better system 2 type thinking. So it got me thinking, how do you measure risk properly when we know we're affected by system 1 thinking? And what sort of system 2 type thinking is there around the risk questionnaire? And I'm sure everyone who was listening has taken some sort of investment risk questionnaire in the past that helps you and your advisor decide how much risk should there be in your portfolio. And, there's different rules of thumb that I think people have used over the years, like keep your age in bonds. So if you're 50 years old, you'd have half your portfolio in bonds. I mean, we've talked about these rules of thumb in the past with, Alexander McQueen, for example. Or even think back to the discussion we had with Larry Swedroe. Remember his rules of thumb for taking on risk.
Right.
It's based on your ability, your willingness, and your need to take on risk. And he's always adamant, if you don't need the risk, why take it? So we've had a risk questionnaire we've used for years in our practice, and then we mesh, and these are straightforward questions, but we mesh those questions with the overall plan so we get to their client's need to take on risk and get to an asset allocation. But it still begs a question, like what is truly the best way to get to your risk profile? So one of the companies in this industry, I believe it's the largest provider of risk analysis, is a company called Riskalyze. And so we're looking at different providers now for risk profiling software in our company. And what I thought was interesting with them is they actually commissioned 4 academics, including 3 PhDs, to look at their technology and to give some feedback, some academic feedback on how they were doing their questionnaire. And it's super interesting to me because their questionnaire gets right to the point of where do plans typically come off the rails in terms of people's risk level. And that point is what we call the GMO point, the get me out point. So most questionnaires, and ours included, is usually softer questions like, how do you typically think about risk? Do you enjoy the thrill? Are you a risk type person? How much time do you have?
What's the name for those type of questions?
Those are psychometric questionnaires. Right. So they do a psychometric profiling of you to help get to some sort of asset allocation that makes sense for you.
But the Riskalyze research is saying that psychometric risk profiling is not ideal?
Not ideal because it leads to much more subjective interpretation, is my interpretation. I'm not professing to be an expert in this. This field is huge, is my takeaway from this. Like there's so much study on this. My mind's been blown on this in the past week. But their point is what really matters is what causes you to decide, get me out, because that's where the plan gets derailed. And if you have to find out where that point is, and that does not come out as clearly in a psychometric profile.
Oh, just the get me out point and how bad that is. Where did I see this? It was something with Larry Swedroe. I hope I don't misquote him here, but he referred to getting out of the market as portfolio suicide. Because once you're out, now what? Like there's no way to know when you should get back in. And by the time you decided it's right to get back in, it probably means the market's recovered, which means you've eaten the loss and missed the gain.
The stress does not end when you get out.
Right.
You have to decide when to get back in. Like, will you sit in high interest savings or some sort of GIC portfolio or annuities? Is that enough?
I've heard from, and I don't know where this was. I got a lot of messages from people on like Twitter and LinkedIn and email sometimes, although less because I've tried to take my email down everywhere. But anyway, so I've had a few people message me saying, I got out in, the bottom of 08 and I've never really gotten back in. Do you think now's a good time? It's like, man.
Wow.
That's 12 years.
That's a lot of pressure too.
Yeah.
Anyway, so I've been playing with this questionnaire from Riskalyze, and it starts with a little slide, which you slide across how much risk you are willing to take on in your portfolio. And what is interesting is that it shows in percentage terms, but also dollar terms. And people's risk profile changes in dollar terms more than percentage terms. So the example they gave, and I've read this in a couple places, because they base their profile on lottery gambles, like would you prefer type questions. For example, at a very basic level, if I give you, Ben, a choice, I give you a 50-50 chance of either getting $0 or $10, how much would you be willing to pay for that bet?
A 50-50 chance of getting $0 or $10?
Yep.
I mean, $5, I guess.
So a risk neutral person would pay $5. If you're conservative, you'd pay less. You're risk averse. If you're more aggressive, you'd pay more because you're risk seeking. However, if you have a 50-50 gamble between $1,000 and $1 million, or take $300,000 for sure, then what would you do? Because now you're talking bigger numbers and real money. So what Riskalyze does in this gamble is they find out where that optimal utility function is for you. So they keep playing this gamble to force you to decide with numbers that are similar to your own portfolio so that you can make real choices that affect you, as opposed to some questionnaire. And ours does this. How much downside would you accept in your portfolio? Well, if you don't link that to the real amount of money you're managing, it does not have the same amount of meaning.
Okay. So let me rephrase what they're doing, and you can tell me if, because I unfortunately have not read this paper because we had a baby a couple of days ago. I was starting to read it, and then we had to go to the hospital. So I haven't had a chance to read it. But what it sounds to me like, they're using these lottery questions to build a utility function for each individual person. Is that right?
Correct.
Wow. That's cool. That's cool.
And this is one of the models for assessing people's risk. And it forces you to the point of where you actually bail on your plan. And that my takeaway is, having lived through this for a long time, that is all that really matters. Asking you if you enjoy the thrill of investing, who cares?
Oh man. Okay.
Because you enjoying the thrill of investing and me enjoying the thrill of investing might be totally different. How we define thrill. Do you have a risky lifestyle? Do you enjoy hang gliding? Who cares?
We might have different utility functions.
Correct.
When it comes to our portfolios, which could depend on the size of our portfolios. And it probably does. Like I don't have the research in front of me. I've definitely seen research that risk aversion changes with wealth.
So they highlight in this paper the best ways to do a lottery choice. Number one, it must be consequential. For example, it must be real in dollar terms to your own situation. It must be simple. It must be specific, i.e. not an open-ended question, such as, do you like to take on more risky options or do you prefer more certainty? It's not specific enough. And it must be enough choices to narrow down your utility number. And that's what this questionnaire does. Now, we've not decided to work with Riskalyze. This is just me learning more about this tool to use the gambling proposition in making a decision about your own risk profile. Believe it or not, they actually referenced a paper from Charnas, Nisi, and Imus called The Experimental Methods Eliciting Risk Preferences. And they highlight 5 different methods of appraising one's risk tolerance. One is, they actually have this as an example, the balloon analogy risk profile. See those examples? You hear them on the radio, for example, where how long you're willing to let the song play before you take your money and bail. You've heard those things before. This one uses a balloon. So you let the balloon inflate until a certain point that you get to your risk profile. Say, okay, I'll take my cash before the balloon blows up. If the balloon pops, you don't win. So that's one example. Another one is basic questionnaires, like we've mentioned. There's one called the Nisi and Potter's method, which is a simple question of how much of your portfolio would you be willing to put at risk. There's another one called the Eckel and Grossman method, which uses these series of 50-50 type gambles. Another one is a risk tolerance quiz. Like, I consider myself highly knowledgeable on a scale of 1 to 5. But again, that's a perfect example of something that is virtually impossible. Like, are you a 5, Ben? Are you a 4?
Oh, that idea of developing a utility function for each individual based on their preference for risk, based on their actual amount of assets, is that's very appealing. Very appealing.
Yeah.
I was just thinking about, as you were talking, like, it's easy to say the expected returns are higher in a 100% equity portfolio. But if you end up bailing, which you don't know if you're going to do, if you end up bailing, you might have been better off 60-40 the whole time and never bailing. Even same thing, 60-40. Maybe you're better off 40-60 if you're going to end up bailing.
Anyways, the punchline in that paper from Charnas, Nisi, and Imus at the end said, so what makes a good questionnaire? One that leads investors to stay invested. To your point.
Yeah, it's interesting. That is fascinating. And you think about people who, I mean, we have not been using this. So this is anyone who's being advised or not, it's highly likely that their risk profile has not been established based on an appropriate utility function, which is fascinating to think about.
Yeah.
And then you think about individual people who don't have access to advice. Like how do they establish risk preferences?
Exactly.
Fascinating.
Anyways, I thought it was fascinating. More to follow on this as I do more research, but I thought it was incredible. So on to bad advice of the week.
Yep.
As you can hear my dog in the background wanting a snack.
Yep. My kids are screaming down there too.
So we'll make this quick. Number one, I just thought I'd highlight some quotes I found on Twitter in the past couple of weeks, which I find incredible, just talking about rebalancing portfolios. Anyways, here's this quote. You'll enjoy this one. At this stage of the game, don't put all your money to work. It's time to start nibbling, but not gorging on values. Aren't you hired to manage portfolios with certain asset allocation? And here's another one. Don't be fooled by these rallies in the market. We are using them to trim the equity exposure in our portfolios.
Maybe it ends up being true. Maybe things drop again. Who knows?
But what decision point do you have that's better than... Anyways.
I'm not saying it's good advice. It's bad advice. They just might end up being right.
That's what I thought you get a kick out of. I bet you haven't even seen these notes yet because I just added them. But Direction ETFs, which is a big ETF firm in the US, they're launching a new ETF called Work From Home that's going to track companies that are specializing in remote working products, since they, quote, as this Bloomberg article pointed out, these stocks are becoming hot. And it actually got the symbol WFH.
Oh, wow.
Yeah. Anyways, Direction is, quote, expanding into buy and hold funds since they normally focus on leveraged ETFs.
Oof.
But
sorry. Total digression.
Anyway, Morningstar's co-head of passive strategy research said, this too shall pass, and investors have already bid up the shares a lot of these stocks. So I think that's kind of a little bit more sensible, but makes me laugh how a company is so driven to product to take advantage of this, work from home era. Incredible to me.
It'd be fascinating to look at. This is my digression. To look at the just Direction made me think about it. We talked about leveraged ETFs a while ago and the decay that you can get in times of high volatility. It'll be interesting at the end of this period to look at the returns of manually leveraged, borrow to invest portfolio versus the leveraged ETF portfolio. Just because of that daily reconstitution the leverage ETFs have. I bet there's been a lot of decay from the volatility. Anyway.
Fascinating. Anyway, that's the bad advice of the week. Anything else?
Nope.
All right. Thanks for listening.